Welcome to Striking Options. The show reveals the options you have to better navigate markets. I'm Jeff Kilberg. We've adjusted our show, folks, until we can get back in the studio, but I'm really excited to be joined today by Bob Icino. Welcome, Bob.
Thanks for having me again, Jeff.
Well, it's interesting. Q1 2020 is going to go down in the history books, pal, as one of the most volatile quarters ever. Many investors are still trying to digest the massive daily swings that we've endured. And I want to cover two topics today, Bob. I want to cover equities, specifically the E-mini S&P 500, and I also want to touch on commodities, specifically the crude oil futures, better known as WTI. But we have seen sensational volatility in both futures contract, Bob. But let's dive into the E-mini S&P 500 first. We just witnessed the fastest 35% peak to trough sell off ever in the marketplace, and now equities have had a pretty significant bounce. So the E-mini S&P was traded nearly 3,400 on February 19th and then dipped under 2,200 on March 22nd. If you remember, that Sunday night futures session into that Monday was the recent low, which a lot of investors are talking about potentially revisiting. But as investors really talk about letters that they want to utilize to set expectations of this recovery in the E-mini S&P 500, what do you see, Bob? Do you see a V-shaped recovery, a U-shaped recovery, or are you going to go with a W-shaped recovery as volatility has remained in the marketplace?
I think that's a great question. I personally see a U-shaped recovery. I just think the bottom of the U might be a little longer than people want. When you look at the letter U and V, they look pretty similar. But from my perspective, I think we're going to run along the bottoms here. You can call it a W as well. The tendency of bear markets is to take their time making a bottom. This is not something that generally happens overnight, despite the speed of the fall that we saw. When you look at the 2001 bear market, it took 20 months to reach the low of that bear market. Go back to the '08 bear market, took 14 months to reach that low. And even in 1987, you were talking about 4 months and 17 days once we entered the bear market before we hit the low.
No, that's interesting. And I guess the other side of the fence where I could push back a little bit is that all those historical points, we never saw the velocity of that downdraft. I mean, we're talking nearly 20 trading days to see this move of 35% lower. So we are in a new normal. We will have to see technically how this recovery happens. But I think you bring up a great point to understand what this shape recovery looks like, because we are 10, 12 years post the great financial crisis.
I totally agree. 1987 entered a bear market in the course of 2 days. But you're right. This was a bigger move and it was faster cumulatively. So it could be more of a V.
Okay, well, let's shift gears. Let's briefly dive into the oil patch. We saw crude oil dip under $20 a barrel. Remarkable. And we're seeing analysts state this week that demand is probably going to drop by another 26 million barrels a week. That's just a sensational statistic, which we definitely didn't anticipate, as things were moving fairly well in Q1 when we saw the price of crude oil kind of tethered to $60. But with demand continuing to wane, abundance of supply, the question is, will WTI be able to recover from this plunge in prices? And what is that potential bullish catalyst, Bob?
Well, it's unlikely that crude oil, a physical commodity, trades at zero for any extended period of time like interest rates can. So we should get a recovery, but I'm seeing much more downside before that. Some of the demand is demand postponement, but some is also demand destruction. Business travel, for example, people going to large gatherings, that's going to take a while to recover.
So price discovery mode continues to move crude oil lower short term.
Yes, definitely short term. And then in the long term, some of the destruction of supply, particularly in the shale patch, could actually mean higher prices a year and a half, 2 years from now. But it's too far out to look at that, I think.
All right, Bob. Well, thanks as always for coming on to Striking Options. We want to thank you for tuning in to Striking Options. Please tune in every week as we will continue to strike options.